The script advocates for a disciplined, multi-source verification process, cross-referencing reports, investigating author biases and potential agendas, and prioritizing raw data and behavioral metrics over sensationalized commentary. It calls for a shift from being a passive consumer of financial news to an active investigator of financial signals. This process requires acknowledging one's own biases, as the narrator does by transparently stating a long-term value perspective while rigorously separating that bias from the objective data. In the context of XRP, this core contradiction is amplified by the asset's unique history. As an original giant with a massive enduring community and a years-long high-stakes legal battle with the SEC, XRP exists in a perpetual state of narrative tension. It is simultaneously a pioneer, a pariah, a battleground, and a potential phoenix. This rich history provides endless fodder for conflicting takes. The legal overhang can be framed as an existential threat or the sole reason for a discounted entry. The loyal community can be seen as a strength of conviction or an echo chamber of bag holders. Cutting through this requires holding two competing truths at once, recognizing the objective reality of the legal risk while simultaneously analyzing the market's behavior in spite of it. Ultimately, navigating this core contradiction is the foundational skill for modern crypto investment. It moves the discipline away from prophecy and towards forensic analysis. The script's opening establishes that the journey to understanding XRP potential is not about finding the one correct headline, but about learning to mute the cacophony of external noise in order to clearly hear the often subtle, sometimes contradictory, but always revealing internal signals of the market itself. The reality check it promises is the realization that truth is not delivered in a headline, but constructed through the careful synthesis of data points that persist despite the noise. This sets the stage for the subsequent analysis, which then proceeds to examine those persistent signals, the resilient price action, the peculiar sentiment data, the looming legal catalyst, with the clarity that only comes after the noise has been consciously filtered out. The concept of a foundation in financial markets is often abstract and metaphorical. For XRP, however, this foundation is not a mere figure of speech. It is a quantifiable, observable architecture of market behavior that has been stress-tested under significant. This resilience forms the bedrock of its current investment thesis, distinguishing it from assets driven purely by speculative narrative. To expand on this keynote is to move beyond simple price points and market cap rankings, and to dissect the multi-layered structural integrity that allows an asset to weather storms that capsize others. It is about understanding why XRP didn't fall as hard, what that price action reveals about its holder composition, and how this creates a unique setup for future movement. The most visible pillar of this foundation is persistent top-tier market positioning. Maintaining a position within the cryptocurrency top 10 by global market capitalization is an endurance feat of immense significance. This ranking is a dynamic, real-time consensus of global capital allocation, constantly challenged by innovative newcomers, shifting narratives, and volatile market cycle. For XRP to hold this ground, not as a fleeting visitor following a hype cycle, but as a consistent resident, speaks to a deep-seated and enduring valuation anchor within the broader ecosystem. It signifies that a substantial pool of capital views XRP not as a disposable speculative token, but as a systemically relevant digital asset with established utility, brand recognition, and network effects. This positioning provides critical liquidity, ensures continuous institutional and exchange scrutiny, and acts as a gravitational pull that prevents the asset from drifting into obscurity during bear markets. It is the market's way of voting daily on continued relevance. Yet, the more telling aspect of this resilience is revealed not in static ranking, but in comparative price dynamics during systemic stress. The script highlights a crucial data point. During the recent market-wide corrective dip, XRP price decline was less severe than that of many peer assets. This is a profound signal that operates on multiple levels. Technically, it indicates the presence of a strong support zone, a price level where buying interest consistently overwhelms selling pressure. Behaviorally, this price action is a direct window into the psychology of the holder base. A shallow decline in a panic suggests a lack of weak hands. There is no mass exodus, no capitulatory selling from investors looking to cut losses at any cost. Instead, the market encounters a cohort of holders whose conviction is not shaken by short-term volatility. This is the hallmark of a diamond hands or long-term holder, LTH cohort, a group that bases its holding thesis on fundamentals, long-term legal outcomes, or a deep belief in the project's ultimate utility rather than on daily price charts. This behavioral pillar leads us to infer a sophisticated and committed holder composition. The XRP army is often referenced anecdotally, but the price resilience provides empirical evidence of its impact. This is not a homogeneous mob, but likely a stratified community ranging from retail believers who accumulated during earlier cycles to strategic entities, payment providers, and funds that may hold XRPs for its intended function in cross-border settlement. This diversity of holders united by a longer-term vision creates a stable core. They are not active traders providing liquidity for daily swings. They are foundational blocks, absorbing selling pressure and effectively reducing the circulating supply available for panic dumping. Their commitment transforms the asset's volatility profile. It becomes less prone to hyperbolic, sentiment-driven collapses, and more prone to consolidating in a range, building a sturdy base from which to advance when a catalyst arrives. This composition acts as a shock absorber for the entire asset. Furthermore, this resilience has been forged in the fire of persistent adversity. It is essential to contextualize this foundation building. For years, XRP has operated under the cloud of the SEC lawsuit, an existential threat that led to its delisting from major U.S. exchanges. This adversity created a unique selection pressure. Any holder without deep conviction had ample reason and opportunity to exit. The holders that remain, therefore, are those who have consciously decided to endure legal uncertainty, reduced liquidity access, and constant negative headlines. Passing through this filter has arguably created one of the most battle-hardened and conviction-driven holder bases in crypto. Their resilience is not theoretical. It has been proven over a multi-year timeline of negative catalysts. This means that when positive catalysts emerge, this base is unlikely to sell into the first sign of strength. They have waited too long and endured too much for a modest gain. Their price targets are likely materially higher, which could amplify upward momentum as selling resistance remains high. Finally, this resilient foundation creates a specific and powerful technical and psychological setup. On a chart, this behavior forms what analysts call a higher low or a notably firm support level following a market washout. Psychologically, it builds trust in the asset's floor. For new capital considering an entry, the demonstrated ability to hold firm reduces perceived downside risk. For existing holders, it reinforces their conviction. This creates a virtuous cycle. Resilience attracts steady capital, which further bolsters resilience. It sets the stage for what market technicians describe as an accumulation zone, a period where an asset trades in a relatively tight range after a decline, as informed buyers steadily absorb supply before a new trend begins. In conclusion, XRP Resilient Foundation is a multi-dimensional construct. It is the product of enduring market relevance, top 10 status, demonstrated price fortitude under stress, a self-selected and committed holder base forged in adversity, and the resulting technical formation that signals accumulation. This foundation does not, in itself, guarantee a price explosion. What it does provide is something arguably more valuable, a stable and predictable launch pad. It ensures that when the primary catalyst, the legal resolution, arrives, the asset is not structurally weak, crumbling under its own weight at the first sign of momentum. Instead, it is structurally sound, primed to translate positive energy into sustainable upward movement because its foundation has been tested and it is held. In the cacophonous arena of cryptocurrency markets, sentiment is often mistaken for noise, a chaotic, emotional byproduct to be ignored in favor of hard technical data. This is a profound analytical error. Sentiment, when measured correctly, is not noise. It is the very signal of collective human psychology, the fuel that drives price discovery beyond mere mathematical models. The Scripps analysis of XRP sentiment reveals a pattern that is counterintuitive to the casual observer, but deeply revealing to the behavioral analyst. The absence of screaming bullishness is, in this specific context, a powerfully bullish signal. This is the whisper of pent-up demand, a phenomenon far more structurally significant than the shout of euphoric hype. To expand on this keynote is to move beyond sentiment as a simple greed versus fear gauge and to understand it as a complex narrative of accumulation, patience, and latent energy awaiting a trigger. The initial insight lies in deconstructing the sentiment timeline. The script maps a critical sequence: positive sentiment preceding a price drop, a spike in negative sentiment aligning perfectly with the price low, and a subsequent recovery in price not accompanied by a commensurate surge in positive sentiment. This sequence is a classic behavioral fingerprint. The pre-drop positivity often represents naive optimism or weak-hand enthusiasm that is easily shattered. The violent flip to negativity at the bottom is the moment of maximum pain, capitulation, and fear, the point where the last of the uncertain holders sell. The crucial phase is what follows. The price begins to climb, but sentiment does not rebound to previous highs. It stabilizes. This indicates that the rebound is not being driven by a new wave of frothy emotional buying, which would register as soaring positive sentiment. Instead, it is being driven by something quieter and more determined: strategic accumulation. This leads to the core concept: pent-up demand versus realized hype. Hype is sentiment that outpaces price. It is the loud social media-fueled frenzy that often creates parabolic, unsustainable moves. It is characterized by a high sentiment-to-price ratio. Pent-up demand is the inverse. It is buying pressure that exists despite subdued or neutral sentiment. It is accumulation happening in the shadows, not the spotlight. For XRP, this manifests as consistent buying from entities and individuals who are not broadcasting their actions on Twitter or Reddit. They are not driven by the fear of missing out, FOMO, on a trending narrative. They are driven by a fundamental thesis about legal resolution and long-term utility. Their activity registers in on-chain flow data and exchange net volume, but not in the exuberant language of social sentiment trackers. This creates a powerful divergence. The price action begins to trend positively while the social narrative remains cautiously neutral or even skeptical. This divergence is a potent leading indicator, as it suggests the move is underpinned by conviction rather than emotion, making it more durable. The behavioral engine behind this is the psychology of the quiet accumulator. This actor is distinct from both the panic seller and the hype-driven buyer. Their psychology is defined by three key traits. 1. Narrative patience. They are oriented toward a specific future catalyst, the lawsuit outcome, and are willing to accumulate in the uncertain present to position for that future. Their time horizon is measured in months or years, not days. 2. Contrarian resolve. They interpret negative or neutral sentiment not as a warning, but as an opportunity. They understand that the best prices are rarely offered amid universal optimism. The lack of bullish chatter signals a lack of competition for assets at the current price level. 3. Informational confidence. They believe they possess an analytical edge, a deeper understanding of the legal process, the technology's use case, or the market's mispricing of risk that the broader sentiment reflecting crowd does not see. This confidence allows them to act against the prevailing emotional tone. Therefore, the sentiment data acts as a filter for market participant quality. A market roaring with uniformly positive sentiment is often a market saturated with weak, late-coming capital that will flee at the first sign of trouble. A market showing steady price recovery on neutral to guarded sentiment is a market being fortified with strong, smart capital. This capital is sticky. It does not rotate quickly. It enters with intention and exits based on a fundamental change in thesis, not a shift in social media mood. For XRP, the sentiment metrics suggest the asset is undergoing this very process of quality capital fortification. The army is not chanting, it is quietly building its position. Finally, this analysis necessitates a sophisticated toolset for sentiment interpretation. Relying on simple aggregators of social media buzzwords is insufficient. True sentiment analysis for a complex asset like XRP must be multimodal. It must layer social volume, how much it's being discussed, with social sentiment, the tone of that discussion. Then cross-reference it with trading sentiment from derivatives markets, funding rates, put-call ratios, and on-chain sentiment from holder behavior, hodl waves, exchange net flows. The script's reference to the data showing pent-up demand implies this layered approach. The social sentiment may be flat, but if exchange net flows are consistently positive, more assets moving off exchanges into private wallets, and derivatives markets are not excessively leveraged long, avoiding a crowded trade, the composite picture is one of healthy, under-the-radar accumulation. In essence, the sentiment signal for XRP is a lesson in reading silence. The lack of bullish euphoria is not a warning of apathy. It is evidence of a market phase where informed, patient capital is methodically building a position before a known catalyst. It signifies a transition from a fear-driven market, the sentiment low, to a resolve-driven market, the quiet recovery. This creates a powerful technical and psychological setup. The market is not over-leveraged with optimism, meaning there is little hot money to rapidly exit and crush the price. Instead, it is built on a foundation of steady accumulation, meaning that when the catalyst finally ignites the narrative, the resulting buy pressure must compete for a supply that has been steadily absorbed into strong hands. The fuse is being laid not with fireworks, but with slow, deliberate intent. The sentiment is not shouting buy, it is whispering accumulate. And for the astute observer, that whisper is the most important signal in the room. In financial markets, catalysts are the engines of repricing. They are the events that bridge the gap between an asset's current valuation and its potential future value. Most assets are subject to a diffuse cloud of potential catalysts, product launches, earnings reports, macroeconomic shifts, and competitive dynamics. For XRP, however, the catalytic landscape is uniquely, almost unnervingly, focused. The resolution of its ongoing legal saga with the U.S. Securities and Exchange Commission (SEC) is not merely a catalyst among many. It is the singular, non-negotiable pivot point upon which its entire near to medium-term valuation thesis hinges. This transforms the investment analysis from a probabilistic game of weighing multiple factors into a more defined, albeit binary-leaning assessment of one monumental event. Expanding on this keynote requires understanding this catalyst not as a simple news headline, but as a complex structural force, a dam holding back a reservoir of potential energy, the removal of which would reconfigure the entire landscape. The first layer of understanding is recognizing the lawsuit as a multidimensional suppression field. Its impact is not monolithic but operates across several critical channels that directly govern an asset's market vitality. 1. Regulatory clarity, the uncertainty tax. The core of the suit questions whether XRP is a security. This fundamental ambiguity acts as a pervasive uncertainty tax on the asset. It deters institutional adoption at scale, as regulated entities cannot confidently build or list an asset under regulatory siege. It stifles developer momentum, as building on a platform with an existential legal question is a profound risk. This tax suppresses not just price, but the very network growth that drives long-term value. 2. Liquidity and access, the American dam. The lawsuit directly led to the delisting or trading suspension of XRP from major U.S.-centric exchanges like Coinbase. This fractured the global market, creating a liquidity and access barrier for a huge segment of the world's largest capital market. It artificially segmented XRP trading universe, potentially creating inefficiencies and hindering price discovery. The dam in this metaphor is literal. It blocks the flow of capital and users from a massive, high-velocity pool. 3. Narrative and sentiment, the specter of defeat. Regardless of the legal merits, the ongoing case provides a perpetual source of negative narrative fodder. Every market downturn reinvigorates the XRP is doomed by the C story. This casts a long shadow over social sentiment and mainstream media perception, constantly resetting the asset's reputation to embattled, rather than allowing it to be assessed on its technology or use case. Therefore, a favorable resolution is not a simple good news event, it is a catalytic unlocking of compound value. The script describes it as a detonator. This is apt, as the impact would be sequential and multiplicative. First-order effect. Regulatory dam removal. A win or favorable settlement would, de facto, provide the clarity the market craves. The security question would be resolved or severely diminished. The uncertainty tax evaporates instantly. Second-order effect. Liquidity tsunami. The immediate mechanical result would be the relisting of XRP on every major U.S. exchange that delisted it. This isn't speculative, it is a thisness inevitability. This would unleash pent-up demand from a vast, previously restricted investor base into a newly unified, highly liquid global market. The dam breaks and the waters converge. Third-order effect. Narrative inversion. The story flips from embattled XRPs, fights the SAICs to XRP triumphs, establishes legal precedent. This would trigger a monumental shift in media coverage, social sentiment, and institutional perception. The asset would be recategorized from a risky pariah to a compliant pioneer. This narrative shift would attract a new wave of capital driven not by legal speculation, but by the project's fundamentals, now viewed through a lens of regulatory legitimacy. This catalytic structure creates what is known in finance as an asymmetric setup. The current price, therefore, is an equilibrium established within a constrained system. It represents the consensus value among those willing and able to navigate the constraints. A favorable legal ruling doesn't just add a bit of positive news. It fundamentally redefines the system's boundaries. Keynote 1's contradiction is resolved by the catalyst, providing unambiguous clarity. Keynote 2's resilient foundation ensures the asset can withstand the volatility of the repricing and provides the strong-handed supply constraint that amplifies upward moves. Keynote 3's pent-up demand is the quantified fuel that will feed the initial explosive move. Keynote 4's singular catalyst is the lit match. In essence, the 30-day outlook is the calculated detonation sequence.